today's part with the following interruption for a public service announcement.
Welcome to the Investing in Intelligence show, where we talk about artificial intelligence, stocks, and trading. I'm James, here with my co-host Kai, and today we'll be talking about Tempus AI. I want to remind you that the opinions expressed on this show are just that, opinions. They should not be taken as specific advice to invest in a particular way. So it looks like we just got Broadcom earnings, and stock is down. I think you said 7%, and the earnings report looks good to me. We beat the revenue estimate by almost 1%. We beat EBITDA estimate by 4.3%, beat EPS by 3 cents. So beat the $1.21 estimate by 3 cents. EBITDA guidance beat by 1.2%. And the only thing that wasn't completely perfect was a very slight miss on revenue guidance. So yeah, once again, looks like another situation of a pretty good earnings report to me where it wasn't perfect. Now, one thing I will say before I get your reaction, this guy, the CEO, is pretty infamous for being a straight shooter. He does not sugarcoat things. So if you get a report that's not perfect with Broadcom, he's going to say something that's going to concern the analyst. So I've listened to their earnings call in the past, and he definitely does not talk up his company. He's very straightforward. So they're famous for him kind of making things a bit worse than they actually are, essentially. Yeah.
Yeah. So it's down, what, 6-7% after hours?
Yeah.
Correct?
Yeah.
Yeah. I mean, not worth the drop. Yeah. Every earnings season, to me, starts to have a theme associated with it. Some themes are, the earnings may just be in line, and yet we see these companies shoot up 5 to 10%. Some theme may be, in last October, one theme was like, wow, some of these earnings numbers are pretty good, but they're really hammering still some of these companies. If they just whiff a little of a miss, and or it may not be just killing, it out the ballpark. And this earnings season has definitely been, for me in particular, trying to summarize it up into, if the AI companies miss on basically forward revenue or guidance a little bit, then they're hammered, and or there's an overreaction, in my opinion, to the stock price. Because there's AI future fears that maybe AI won't be as profitable as we are expecting it to be. Whereas other companies that are already hammered, we've talked about some of them before, and they don't post great earnings, we may still see them actually increase in value, because some of those companies that are non-AI play companies are already have taken a hit. The consumer is very tight. We know that, but that seems to be the theme. I have a large position in Broadcom. You said we, like we were all in this together for AVGO Broadcom, but what about you, James?
Yeah, I've tried to go equal weight with my portfolio. So SMCI was kind of my lesson to be a little more equal weight with my AI stocks. And I've got a lot. I've got like almost 30 potential AI stocks. And so I have more or less the same amount in every stock now, rather than having a few ones that I really deeply believe in. Your beliefs can hurt you when you're investing. So it's better to be smart than emotional. So yeah, I have the same amount in Broadcom that I have in pretty much all of my AI holdings now. I did want to react to one thing that you said. You said there's some doubts right now about the profitability of AI, and you said it better than I could. I think that's the big story of the past weeks and maybe the past month or two, because there have been some pretty significant, very highly quoted reports that have come out saying, no, AI is never going to pay for the amount of spin that's going into it. And then the two things I want to say on that, first of all, this is actually a normal cloud upgrade cycle. So the big cloud providers actually upgrade their data center equipment every 4 or 5 years. And this is pretty much normal spend for a normal upgrade cycle. The difference is that they're buying more GPUs than CPUs for their data centers, because accelerated computing is in vogue and it's being more and more used for traditional workloads. And the other thing I would say is, no, we're not going to get the kind of profitability that you're thinking, because AI is similar to the internet. And does anyone ever say, is the internet worth the amount of money that was invested in it? Is the internet highly profitable? What's the ROI on the internet? Well, obviously the internet led to tons of smaller things that are profitable. And AI will be the same. AI is going to lead to lots of smaller things that are profitable, like ChatGPT, which is already making an enormous amount of money. And this past week, we heard that the valuation of OpenAI is going up to $100 billion now. I think Anthropic could be valued similarly to OpenAI. So we're going to have applications, services, all sorts of things that are extremely profitable, but AI itself is a base layer technology, just like the internet is a base layer technology.
Yeah, I think that's actually really well said. I also would make the point, though, that with the billions and billions of dollars that companies like Amazon, Google, Microsoft are basically purchasing chips and GPUs, that return on investments that is billions and billions of dollars should come too. And I think there's an unknown there for the investor, because the stock market and earnings rapidly will reward rapid growth. You've said that before. I agree with that, but they want to see that play out. I mean, Nvidia can beat earnings, kill earnings, and do well with earnings, but then drop 25% over the course of the month. For even though that they're killing earnings, just because they're not seeing 100% growth, or companies can only buy so many GPUs. Nvidia can only make so many GPUs, and that does not mean that Nvidia should lose that much market cap. When others are fearful, be greedy. I won't take advantage of that line, but that's one of the things Warren Buffett has said, and I agree with that. Now, Nvidia is at this support level of around 100. AVGO has broken through its 21-day and 50-day moving average, and its next really support psychologically is 140. Then you're down in the 130s with their 200-day moving average. But a company like AVGO, I am not like you, to our listeners out there. I'm not equal weighted in my investments. I'm trying to pick the AI plays or the build out phase of AI plays that I think have a better value for my better bang for what I'm purchasing, a better bang for my buck. And AVGO is one of those that I still see the growth that continuing, but also that I like the value that AVGO is. I think AVGO it already split. I think AVGO already split, or I may be misspeaking here, but I like AVGO right now. My plan for AVGO, for our listeners out there, this is not advice. I own a large position in AVGO. I was absolutely hoping for a drop so that I could add to my position in AVGO, and then hoping for some more volatility in the market to increase some premiums and start to sell some covered calls on some of my position in on AVGO. That was my game plan going into earnings. I had planned that all along. I didn't place a trade on earnings themselves, but I'm actually a little bit ecstatic. I am a little bit fearful, market fearful in regards to the jobs report. And I think that's a very realistic fear. I think we saw some of that on Monday with people preparing and, in my opinion, having some large scale selling in preparation for this week. But what do you think for this week, James? I mean, obviously been not a good week for the NASDAQ or tech.
Yeah, I think it's exactly what I've been saying for the last 4 weeks. Ever since we had the last labor report, I've been looking forward to the next labor report, and now we're just hours away. So probably by the time we get this episode out, the labor report will have happened. I think it's the most important event of this year so far. So tomorrow's labor report, think back to the reaction to the last labor report and the revisions that we had on some other job-related numbers, along with the Japanese carry trade unwind. So think back to those things. Think back to how bad it was a month ago. Tomorrow, just hours from the time of this recording, we're replaying that entire drama from last month. Now, the consensus estimate is around 160,000. So we've had actually quite a bit of drama, and we'll get to Tempus AI in just a split second here, but I just wanted to mention we've had quite a bit of drama this week over smaller reports. And usually these smaller reports barely matter, but all of a sudden they do matter. So when people are concerned that maybe we're going into a slowdown, everything is going to matter. I found that MarketWatch has the best weekly economic calendar. So you can see I've got their US economic calendar pulled up here. And on Monday, we kind of started off on a bad note because we had ISM manufacturing at 10 a.m. It comes out 10 a.m. on the first business day, and services ISM comes out 10 a.m. on the third business day. And we had 47.9% was the forecast, but it came out at 47.2%. And then you see we had some other like job openings, beige book, some other things. ADP employment was a thing today that really scared people because it looks like the estimate median forecast for ADP employment today was 140,000 and it came out to be 99,000, which is way less than people expected. But tomorrow is the biggest event. And you can see here the estimate is 161,000. The last result was 114,000. So, just looking logically, I say, okay, last time we were 114,000. We really think we're going to be 161,000 this time. But and also last time we were 4.3% unemployment. Do you really think we're going to be 4.2% this time? Some of these other numbers would indicate maybe not. So, so I guess tomorrow is the big day. Unfortunately, after probably, we might not get this episode published by the time it comes out, but stocks either go up or down tomorrow based on this result. There's nothing else that matters tomorrow but this result.
Yeah, and I think for investors out there that one of the things they should do is have a plan. I mean, you should have an idea of what's coming, what storms or what clean air and good weather is on the horizon. And weather is unpredictable too, but you can get an idea of what may happen and prepare for it. So I do think that's something you should do is have a plan, have a game plan. And it's okay to part of your game plan to be a wait and see approach. I don't think potentially just saying, oh, wide scale selling, let me sell is the good idea here because we still are in a bull market. We're above the 200-day moving average. And some buying opportunities have been presented, especially in tech over the last few, basically early August and again at the start of this month. So yeah, we'll see what happens. All I know is what I know. And what I know is the consumer's I was actually shocked that it took this long for the consumer to get tight. And that has been a consistent theme. How many, for example, in the service industry, how many CEOs have come out and said, even on their earnings report, we are seeing tightening of the consumer. We are seeing that across the board when you know that credit card debt and other things are at an all-time high. So at some point, there's going to be a straw that breaks. I mean, at some point. And so maybe it is the labor market here, but we do have the Fed on the horizon as well. My prediction is that if it comes in line or even maybe slightly better or a slightly bit worse, I don't think we're going to see a huge change. But if we see it going up, basically unexpectedly to an unexpected amount, I think we're going to be in for some really rough waters.
Yeah, two things on that. So first of all, you talk about having a plan. And what you mentioned is probably the most common plan that people have, which is like sell everything and wait. So it looks like we're going to a recession, sell everything and wait for things to get better. But I think that there are some, in particular, three other things that are a better plan to have. And that would be put spreads, so options to the downside, bearish options, or inverse ETFs, or lastly, which is my new favorite, is just buying bond ETFs. So I actually made money this week because I have, I know this is going to sound terrible for someone who's on an AI investing podcast, but I have twice as many bond ETFs as I do AI stocks right now. So the overall dollar amount that I have in bond ETFs is twice as much as what I have in AI stocks right now. So this week I actually made money because bonds rallied, meaning that people bought bonds and the interest rates went down. But when the interest rates go down, the price of the bonds or the price of your bond ETF can go up significantly more than the interest rate goes down and way faster than the interest rate goes down. So I've sent you my list of like 40 different bond. I mean, I've got high grade corporate, I've got municipal bonds, I've got treasuries, I've got all these, got different durations of treasuries. I've got all these ETFs. I would say my average interest rate on each ETF is 5%. But then they could make 40%. If interest rates went all the way to zero, those would make 40% just in the appreciation price of the ETF. So there are really smart ways to play these things. You just have to educate yourself on ways to do it. The dumbest way is just to buy like inverse S&P, negative 1 times inverse bearish S&P ETF. They have those. You could just buy an inverse ETF for whatever S&P Dow. I think they have them for, I don't know if they have them for specific stocks or not, but actually they do, but only for big ones like NVIDIA.
Yeah. So what's your prediction for tomorrow for Alyssa? I'm predicting inline or slightly worse. And I think the market is not going to really take that as heading into bear territory. I think it's going to it's not going to sell off. I think it'll move one way or the other, but I think they'll actually take that as good news that it is the same or slightly worse, knowing that the Fed is around the corner. What's your prediction?
Well, I told you that my favorite economist said they thought maybe it would be a little bit above like 170,000, that we would come from 4.3 to 4.2. So I think it's possible. They're citing some kind of hurricane, I don't remember what. Apparently skewed the number last time. That's what they're citing. But the bigger question for me is, if this is a trend, what does it mean? What does it really mean if employment is going down and GDP is going up? So what does it mean if... And I want to just clarify that question there. This is a pretty big deal. So I asked you this on the phone. What does it mean when unemployment and jobless claims are going up and GDP is high and going higher? Those two things are moving in the same direction, which is a rare scenario. What does that mean?
Well, I don't think that that's what's going to happen. I think GDP is going to
it is what's
eventually
happening.
not. Well, I know what's happening right now, but I don't think that's what's going to happen in the future.
Okay, but if it is what's happening, it's a very rare scenario, and it means productivity gains. And that productivity gain could be coming from AI. Government spending could be causing it also. We might not even know what the real job numbers are due to so much government stimulation, but it could be due to productivity gains from AI. Literally everyone in the world now has the best assistant they could possibly imagine in ChatGPT and Anthropic's Claude. So that is a big productivity. That's like a 5% productivity gain for the entire world. So
we have a governmental spending problem. We are at an all-time high in national debt. What goes up must come down. And when you spend more money than has ever been spent in the face of the planet, you are going to have inflation, especially with less goods available. So let's talk a little bit about, do you have any comments to that? Number one, I don't want to cut you off there. And then let's talk a little bit about Tempus AI. And then let's just do that. But before that, I want to hear too, what's your theme on this sort of earnings season wrapping up? What's your theme? Well, if you had to give it a theme.
My theme for this earnings season is the whole season we were just waiting for the next labor report. And now that comes in about 16 hours from now. So all right,
there we go.
Yeah.
So maybe all the mutual funds out there waiting for the same thing. So Tempus AI, we've seen build out, a company's benefit from the build out phase of AI. We've seen some bust, like Intel, geez, like, and now let's talk about Tempus AI. So medical, healthcare sector. Yeah.
CAVA IPO June 15th, 2023. Tempus AI IPO June 14th, 2024. CAVA's first earnings report was a revenue of 175 million. Tempus AI's first earnings report was revenue of 166 million. So is Tempus AI the CAVA of AI stocks? That's kind of how I want to put it out there to start. So what they do, obviously small cap company, very similar to when CAVA first IPO'd, they do AI enabled diagnostics. So when I first saw Tempus AI, I didn't even look at it. I just wrote it off immediately because I thought, oh, this is some little fake AI company. Like we've got these little AI companies like SoundHound AI. We've got something called Bear or Big Bear AI, something like that. So we have C3 AI, which actually I would like to look at some point, but we have some companies that have put AI after their name, and I generally don't pay any attention to them whatsoever, especially if they IPO'd recently in the last couple of years, because I assume that it's some kind of play on AI that's not really going anywhere. But what I noticed with Tempus AI was that the stock wasn't going down. So it's IPO'd and had an immediate 22% drop, and then it's been pretty much up only since then. And when the analysts first released their coverage on Tempus AI, all of them rated it as a buy. So after its 22% drop, 8 firms came out and all rated Tempus AI as a buy. So these things kind of got my attention. I said, well, maybe this is worth looking at. And when I dug a little bit deeper, what I learned is that Tempus AI is actually already a highly established company in the biomedical field. So they do AI-enabled diagnostics. And I would like to play you a really quick clip where there's a host on CNBC who asks, what does Tempus AI do? So I want to just play that for you right now because I feel like this guy actually described it better than I possibly could.
What does Tempus AI do?
So Tempus AI is a differentiated kind of oncology diagnostics company. So they have 2 main businesses. The first of which is they do diagnostic testing on cancer patients. They're among a handful of companies that will test for metastatic cancer patients using next generation sequencing. They look at DNA and RNA across a big panel of kind of proven markers, and they try to match patients that have certain mutations to either approved therapies or clinical trial therapies. This type of testing has been going on for about 10 years or so, and Tempus is amongst 3 or 4 large what we call CLIA labs that are in this market. And there's also hospitals across America also do this on their own. So that's their really main business, and that's kind of the engine of how the company was started.
I'm going to stop it there, but I want to just add a couple things to what he said, and then we'll get your reaction because you probably know more about this than I do. But first of all, they're the largest sequencer of cancer patients by a large margin. Okay, by the time they IPO'd, they're already the largest sequencer of cancer patients in America by a large margin. They're also one of the largest liquid biopsy sequencers in the US, and they've been around for 8 years. This isn't a company that just came out a couple years ago. Now, they IPO'd a couple months ago, but they've been around for 8 years, and they're already a leader in the medical testing field. So, Kai, before we go any further, and I have some other things I'd like to say about, especially on the data front, and why I think they're an impressive AI data play. What do you think about their business? Can you give a little more insight on what specifically they do? Because the layperson doesn't understand anything about sequencing or biopsy, or maybe they heard grandpa had a biopsy on his skin or something, but they don't know what this is all about. So can you tell us a little bit more about what is this stuff about?
Well, sometimes in particular cancers, you want to find out some sort of genetic sequence that may be able to target your therapy for that particular type of cancer. Also, sometimes we can use these things for early detection, and also into risk factors for cancer, malignancy, potentially help with detection. And so if that gives you an idea. So for example, if James, you were diagnosed with a tumor or cancer and it was removed and you needed some sort of therapy afterwards, that there may be some sort of genetic testing on the particular type of, or on the tumor to determine what particular type of therapy may be best to treat you. Now, there are certain cancers that we do this with, as far as I don't know about with Tempus AI's technology, but as far as genetic testing of the tumor itself, there are some tumors that we already do this with. But beyond the point of all of that, the one issue I have with Tempus AI currently is the evaluation and basically what it's trading at. But just from a possibility standpoint, also in the way something like that may work, one of the things that we're doing well is being able to determine how tumors behave, for example. However, one of the things that's not been done real well is being able to find treatments, and or even if you were able to say, okay, this particular tumor has this particular genetics, we only have so many therapies that are for example, cancer. There's only so many drugs out there. Does that make sense? We haven't developed potentially a lot of new methods of chemotherapy. We have chemotherapy and radiation and hormonal therapy, but there's not lots of other options. And so I don't think that part of the technology is drastically increasing. And so I'm not for sure, and I'm speaking really how this is going to help in certain ways, potentially. So there's some unknowns there is what I'm going to say, where this will go.
Well, Tempus AI says that they've got 10,000 oncologists already regularly ordering their tests, and there's only 14,000 oncologists in the US. So they've got 2,400 hospitals in the US feeding them data. There's only 5,500 hospitals in the US. So they're already over 50% penetration on oncologists, and they're already at 50% penetration on total US hospitals. So it sounds like you're a bit of a Debbie Downer kind of on their adoption, but they make it sound like they're already massively adopted. So they say sequencing has been growing 25% per year, and they've been growing even quicker than that. So I don't know, man. Just give me I guess what I would say, sum it up for me. Do you think that the kind of sequencing they do for targeted chemotherapy drugs, I think is what you're saying, is that going to keep growing? Is it going to be a big thing, or is it not going to be a big thing?
I don't know ins and outs of the businesses as far as these sort of the genetic testing company goes. I don't know the ins, but I know pharmaceutical companies make a lot of money. And one of the things that goes with pharmaceutical companies, especially while the drug is not generic, the company will make a lot of money. And so I'm saying that that even though they can do the testing, I'm not for sure that we have the targeted therapies yet to be able to make the testing worth it. So therefore, what's going to be the appetite for paying for the tests? It sounds like Tempus AI is being able to utilize a lot of this genetic testing to then be able to develop better testing, and using AI to develop better testing. So I don't know.
Let me play one more clip for you, because I think when you get in one way or another, there is a huge amount of demand based on what they're saying for their products. And let me play one clip for you where he kind of talks about their data and what they do. I think this might clear things up a little bit on one front.
But you have to give us clinical data for your patients, because we can't marry these things and help you make data-driven decisions without the clinical data. So we'd walk in and we'd say to people like, hey, we're going to sequence your patients, but oh, by the way, you have to give us all the data. And we need to keep a copy of it and be unrestricted, because we have to figure out how to use the data. And it's really expensive to mess with the data. So we have to at some point make money or we're not sustainable. And that was a really hard message originally. But there was definitely an inflection point where enough hospitals had said yes that it became really easy for the next hospital to say yes. But I can't remember when that was, and certainly...
All right, so I'll stop it there. So at this point, as far as data is concerned on their patients, they have 250 million gigabytes of data, and it grows by 20 million gigabytes a month. So they have an enormous amount of proprietary data. And what we've learned with AI over the past year or two is that proprietary data is pretty much the most valuable thing in AI. So OpenAI is paying publishers to use their articles and their data and things like that. It's not really making a model. It looks like almost any big company can make a model. Any mega scaler can, any hyperscaler can train a model. So it's not really the model that's the most valuable thing, especially considering we have open source models now. It's really proprietary data. And Tempus AI is a massive owner of human data, biological data on people. I think that data will only be more valuable in the future. The concern that you brought up, you said, well, look at their valuation. This is a CAVA. I mean, when CAVA came out, obviously their valuation is still pretty crazy. But when you have a small cap company come out like this, they're going to be losing money. If they were already massively profitable, they'd probably already be public, but they're not. So in this case, they see profitability coming in 2025. We're not there yet. We don't know what's going to happen. But for small caps, I mean, would you have liked to get in on CAVA before it went up well over 100%, 200%?
I can understand selling Mediterranean food and looking at the numbers to decide whether a company's profitable, looking at their EBITDA and their EPS and their revenue. I don't know entirely where Tempus AI fits in the medical healthcare picture. Basically, what he's saying there is, in order for them to be able to sequence and even come up with new tests, they need the data first, right? And there's a whole bunch of challenges in regards to getting basically every pathological diagnosis that then has to be able to send those slides or send the tissue to this company for them to be able to run genetic testing on. And then, so they do the genetic testing on these tumors, and then what do they do from there? They say, oh, well, this tumor has this sequence and the studies and basically the data collection that may be able to come into that to then be able to develop a test to be able to sell it. I think what I like to see is then, okay, you develop a drug and then sell that, because, you know, a company like Eli Lilly, that's a whole different story, because they're basically selling drugs. I can understand, oh, I'm selling James a treatment or a drug for you to take to help with whatever issue you have. And then that cost money. Basically, they're going to sell testing to these hospitals somehow or come up with a test. I don't see the product here yet.
Yeah, I think it's interesting you say that, because your metaphor of a company that develops a drug, well, it just so happens a lot of very small drug developers wind up getting acquired if they actually have success with the drug that they're engineering. Apparently, the process of getting it fully approved through the FDA is very expensive. So a lot of time they get acquired before they even get there. So maybe this company gets acquired. Maybe Tempus AI winds up getting acquired just for their data or something like that.
Maybe. But I could invent, drugs. Sometimes you have to have hundreds and hundreds of drugs trials for you to go through. until you find one that's profitable, and you lost money on all these drugs that you didn't make through to phase 3 trials, and then you come up with your drug that's actually profitable. I don't know if the margins are there or the revenue can be there for testing. And that's my point. I think I like the idea of the data collection. Is it worth something that's not basically has zero EPS, a revenue growth from 150,000 to 500,000, basically without any, that's not basically profitable. I mean, they're negative EBITDA. So to justify an evaluation in the 50s, no, I'm not paying. I am currently not a buyer of Tempus AI because their evaluation is too high based on what I've seen. Now, this is a company is on my watch list for sure.
All right. I am not buying Tempus AI, although they have an extremely impressive database of AI human data that they can use in the future. And they're already a well-established cancer testing company, but at a price around 50, it's just too high. I'd buy if it was around 30 though.
Yeah. Let me give you another analogy. Intuitive Surgical, robotics company. Surgeons use robots to repair or do surgery with. They use their robotics platform. The company makes money on selling robots, which is a product. They make money by the instruments and repair of those robots. The way Intuitive Surgical is AI is the data collection phase. So would you pay for Intuitive Surgical at an evaluation of 50 to 100 or whatever it is, if they're not selling the robots and they're not selling the instruments and they're not selling the correction of those robots to fix them? No, right? I'm not paying Intuitive Surgical just for the data collection right now. I don't know what that will yield in the future. Now, it may, and this may be something, I mean, I just saw on the news somebody that invested in NVIDIA when it was 37 cents a share or something, right? That she invested $10,000 at 37 cents a share, and now that's worth over $1 million. I'm not making it a part of my equal weight portfolio. I'm not making it a part of my heavyweight portfolio. This may be something I watch, and you may be able to get in Tempus AI at the right time, right when they come out with a test they're selling. Maybe they are selling a test. I don't want to speak to that, but I haven't read through that. Or something that makes them profitable. Maybe you're seeing continued revenue growth. Maybe more hospitals are buying in. Maybe they come up with some sort of business plan. And this may not be the case where they're basically charging the hospitals so much to do genetic testing on their patients or something. I don't know, but I don't quite understand what it is they're selling. And that's one of the other reasons why I'm not investing.
My entire point with the CAVA example is that you kind of have to be there at the beginning. If you want that 10,000% return that people got when they first bought Google or first bought Amazon or first bought any of those IPOs that nobody knew were going to be big, you kind of have to take that risk and buy a little bit. So what they do at Chip Stock Investor, rather than going all in on one small cap risky stock, they put a basket together. So they buy small amounts, smaller than their normal equal weight holdings of these unproven companies and put those together into a basket. So if one blows up 10,000%, you're still going to win. You're not going to win as much as if you went all in, but it's not smart to go all in because a lot of these companies disappear or they just sit there and dither for 10, 20 years. They're one of those zombie companies that makes up like over 40% of the SMH. So did I say SMH? I meant to say the Russell 2000, which is IWM, not SMH, IWM. So yeah, so we can close out, but I just wanted to bring it up because it's kind of the same idea of buying at the bottom. When you have a recession, when the stock market is way down, that's the best time to buy, but nobody wants to because it's the scariest time to buy also. It's the same with these small cap companies. Nobody wants to buy a little unproven company, but it's also the time that if you were to buy, you could make that 10,000% return if it really blew up over the next year. So
when others are fearful, we'll leave it with that. Warren Buffett with some wisdom. When others are fearful, be greedy.
Yeah, there you go. All right. Well, thanks for tuning into our show. Please give us a like or comment. We'll be back in the next episode to cover Onto Innovation. You can find all our holdings and trades at investingintel.ai. Thanks so much, Kai.
Thanks, James.
The first revolution is when you change your mind about how you look at things and see that there might be another way to look at it that you have not been shown. You will not be able to stay home. You will not be able to plug in, turn on, and pop out. Revolution will not be televised, and be no rerun, brothers and sisters. The revolution will be done.